Hello everyone, my name is Isite and I am a member of the International Student Senate. And in today's video, I would like to cover the fundamental concepts of financial statements and explain how we can analyze them and interpret them. Let's get started. So in order to gain a better grasp and idea of financial statements, we must first answer the three following questions. What are financial statements? What do financial statements do? And what value can financial statements bring to you? So financial statements are formal records of the financial activities and positions of a business. They provide a summary of a business's performance over a specific period of time. Financial statements are prepared at regular intervals, usually monthly or quarterly, and at the end of each 12-month period. This 12-month period is called a fiscal year. The timing of the financial statements is determined by the needs of management and other users of the financial statements. For instance, financial statements may also be required by outside parties, such as bankers and shareholders. However, accounting information must possess the qualitative characteristic of timeliness and must be available to decision makers in time to be useful, which is typically a minimum of once every 12 months. The objective of financial statements is to provide information about the financial position, performance, and changes in financial position of an enterprise that is useful to a wide range of users in making economic decisions. And financial statements are valuable to a wide range of stakeholders: investors, creditors, management, and others. It all depends on who you are and why you want to look at the financial statements. But here are some examples of stakeholders that use financial statements and for what purposes they use it for. So for investors, they use it to make informed investment decisions. Financial statements help investors to decide whether to buy, hold, or sell shares. Investors can compare historical performance and predict future performance using financial ratios like return on equity or earnings per share. They can also use it to assess the risk profile of the company. For example, a high debt to equity ratio might suggest that the company is highly leveraged and thus riskier. For creditors and lenders, they analyze these financial statements, particularly the balance sheet and cash flow statement, to determine whether the company can repay its short-term and long-term obligations. Key ratios like the current ratio and interest coverage ratio provide insights into the company's liquidity and financial leverage. Lenders will assess the cash flow statement to ensure that the business generates sufficient cash to meet its interest and principal payments. For managers, they use these financial statements to make informed decisions, such as how much cash is available to invest in growth or how much credit to extend to customers. They may also use this to help identify where cost reductions can be made. On the other hand, they may also use these to understand the profitability of different product lines or divisions, enabling them to allocate resources more effectively to maximize profit. For regulators, they use these financial statements to ensure that businesses are compliant with accounting standards and tax regulations. Any discrepancies or anomalies can raise red flags for further investigation. For employees, analyzing their company's financial statements, they will be able to see if it is growing or if it's a profitable company, which indicates more stable employment, while consistently poor performance may signal downsizing or other cost-cutting measures. For suppliers, they look at these companies' financial statements to decide whether they should offer trade credit. A company with strong cash flow and a healthy balance sheet is more likely to get favorable credit terms. In essence, financial statements are the cornerstone of financial transparency. They provide stakeholders with critical insights into a company's financial performance, position, and cash-generating abilities. Whether you're an investor looking to maximize returns, a manager seeking operational efficiency, or a creditor assessing risk, financial statements offer the data needed to make informed decisions. And with that, let's look into the three types of financial statements. Generally speaking, there are three types of financial statements. There's the income statement, the balance sheet, and the cash flow statement. We're going to get into more detail about each financial statement, and by first understanding their definition, the unique components of each financial statement, and the main formulas that we need to use in order to calculate them. After that, we'll get into more detailed analysis by looking at some examples of these financial statements in use and seeing how we'll be able to interpret them and analyze them. So the first financial statement we will look into is the income statement. The income statement, also known as the profit and loss statement, is one of the key financial statements that show the company's performance over a specific period, such as a quarter or a year. Its purpose is to display how much revenue a company generates and the expenses it incurs, resulting in either profit, which is net income, or loss. And to continue, let's look first at some of the unique components of the income statement. So the income statement consists of several important elements that show how a company makes money and what it spends to earn that money. Here's a breakdown of some of the components. So the first one we have is revenue. This is the total income generated from the sale of goods or services. It's often called the top line revenue because it's the first item on the income statement. The formula, as displayed on the screen, is price per unit multiplied by number of units sold. The second one is cost of goods sold, or COGS for short. This represents the direct costs associated with producing the goods or services that were sold during the period. These costs can include material, labor, and overhead that directly relate to manufacturing the product. The formula is cost to produce each unit multiplied by number of units sold. Our next one is gross profit. Gross profit is the amount of money a company has left over after deducting COGS, which is cost of goods sold, from revenue. It shows how efficiently the company is producing its goods or services. And obviously the formula is gross profit equals revenue minus cost of goods sold. Our next one is operating income. So this shows how much profit a company makes from its core business operations before interest and taxes. It excludes any profit or loss from activities not related to the main business, such as investments or selling property. And for operating income, the formula is also pretty easy to remember. It's gross profit minus operating expenses. Then there's also some more components that I can talk about, such as interest and taxes. But the main one that we need to talk about is the fifth one, which is the net income. And the net income is the final figure on the income statement, showing the company's overall profit after all expenses, including taxes and interest, have been deducted. Net income is sometimes referred to as the bottom line because it appears at the bottom of the income statement. The formula is pretty easy to remember as well. Revenue minus expenses minus interest minus taxes. So it's basically the bottom line after everything has been deducted. Now, I also want to talk about some of the things that beginners are confused about when it comes to learning about the income statement. The first one, and probably the most significant one, is the difference between revenue and profit. Many beginners confuse revenue with profit. Revenue is the total money earned from sales, while profit, also referred to as net income, is the money left after all expenses have been deducted. There's also the issue of gross profit versus net profit. Gross profit is the profit after subtracting only the cost of goods sold, while net profit is the final profit after deducting all operating expenses, interest, and taxes. Keep in mind that net profit and net income are interchangeable in this context. However, it does depend on the business how they decide to label these certain measures in their income statement. So some may have it labeled as net income, some may have labeled as net profit. Honestly, it depends on what type of business you're looking at, what region, and the common accounting procedures that they use to follow in that specific area. Then there's also the case of operating income versus net income. So operating income focuses only on the profit from the company's core business activities, excluding non-operational income like investments. Net income includes everything. And I'll show you some examples of income statements. So here's one which is very basic. I got this one from myaccountingcourse.com. It's pretty simple. It pretty much labels everything that I have just said. You have obviously the revenues at the top, you have the expenses in the middle, then you have the net income at the bottom, and you can see how much the business has left, which is $12,950. It is also very simple, very easy also to conduct and create these income statements in Excel. You know, some people use an accounting software. However, I do think that for most people who are interested in learning finance and business, I think it's very easy and accessible to use Excel because it offers you a pretty good system and a pretty good basis on how an income statement can be structured. There's obviously also a lot of YouTube videos that people can watch. They're also very helpful. Also, there's a lot of good websites. For example, this one, which I'm going to show on my next slide, investopedia.com. It actually breaks down the income statements and all the other financial statements very well. There's obviously, many consider this website to be the go-to website when it comes to learning anything about finance. And yeah, it's also very good. So yes. Then let's look at another common idea, but also a very interesting idea that I wanted to share with all of you, which is the single-step income statement versus the multi-step income statement. So what do I mean by single-step and multi-step? Well, a multi-step income statement includes subtotals for gross profit, operating expenses, and non-operating expenses. A single-step income statement lists line items for revenues and costs and expenses with no subtotals, reaching a total for net income. So as you can see, there's with the direct comparison on the screen here, multi-step, to put it bluntly, is more descriptive with the way that they decide to create their income statement. Whilst the single step is very basic, it's very direct, and you can honestly, both of them show the same financial data, just in different ways. But I do think that multi-step income statements are better for people to understand at first, because it gives you a more detailed analysis of where the money actually is. Now let's look at some ideas of interpretation and analysis when it comes to income statements. So the first one is obviously revenue. One of the main things people can interpret from revenue is growth. You can compare current revenue to previous periods to evaluate whether the company is growing. Consistent revenue growth through consistent income statements can actually signal that it's a very positive sign for the business and that it's going somewhere where it's going to a very profitable state, and it can be beneficial for investors and other stakeholders alike. We can also look at trends. So you can look at seasonal trends or fluctuations in the revenue. Some businesses have higher revenue in certain quarters due to seasonality. An example of this is retail sales during the holidays. And you can also compare this with competitors, comparing revenue growth to industry competitors to assess the company's market position and see how the business is actually doing with its main rivals, with its main competitors. Is it doing well? Is it doing worse? Why is that? This is where you have to go and analyze it a bit more deeper. Next one is obviously cost of goods sold. So a rise in cost of goods sold metric is without a corresponding increase in revenue could indicate shrinking margins or inefficiency in production. A lower cost of goods sold relative to revenue may signal that the company is managing its production costs well or benefiting from economies of scale. Next one we have is obviously gross profit and gross margin. So these are two different things, but people tend to get mixed up on which one is which, and the definitions are pretty similar, but they do have their own differences as well. So gross profit is the money left over after a company's costs are deducted from its sales. Gross margin is a company's gross profit divided by its sales and represents the amount earned in profit per dollar of sales. So gross profit is stated as a number, while gross margin is stated as a percentage. A higher gross margin means that the company retains more revenue after accounting for the cost of production. It indicates pricing power and operational efficiency. A declining gross margin, however, might suggest rising production costs or aggressive pricing to capture market share, which could be unsustainable in the long run. Our next one is obviously operating expenses. You can analyze whether operating expenses are increasing in line with revenue. If operating expenses rise faster than revenue, it could indicate poor cost management, and it may be the first indicator of the business starting to have a little bit of a downfall, and it may cause some concern for investors regarding if the business is actually being run effectively. And obviously, finally, we have operating income, which shows how well the company's core business operations are performing. An increasing operating income over time is a positive sign of operational efficiency. However, you can also compare this operating income to competitors to assess relative performance. And with that said, let's move on to the balance sheet. So let's continue with the balance sheet. The balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It details what the company owns, its asset, what it owes, its liabilities, and the shareholders' equity, the remaining interest in the company after all debts have been paid. The balance sheet is a statement that summarizes the financial position of a company at a specific date. It is based on the fundamental accounting equation shown on the screen. Assets equals liabilities plus shareholders' equity. This equation means that what a company owns is funded either by borrowing or by its owners. The balance sheet gives a clear view of how much a company has in resources and how it is financing those resources. Now, there's also some common areas of confusion for beginners when it comes to the balance sheet. A very common dispute is assets versus liabilities. Beginners may confuse assets with liabilities, and that is totally understandable. Remember, assets are what a company owns, and liabilities are what a company owes. There's also the problem of current versus non-current. So the difference between current and non-current assets or liabilities can be quite tricky. Simply put, current refers to the things that will be used or settled within 1 year, while non-current refers to those that will last longer than a year. And we also need to understand that equity is not cash. Many beginners mistakenly think that equity represents available cash. In fact, equity reflects the shareholders' ownership in the company after debts have been paid off, but not the cash balance. Why does it have to balance? The idea that the balance sheet must balance might be confusing at first. The concept is simple. Everything that the company owns is either funded by borrowing or by money from the owners. Now, we also need to talk about the importance of the balance sheet. For beginners, understanding the balance sheet is critical to any financial knowledge that they will gain in the future. The most basic value that balance sheet provides to everybody is that it lets you see whether a company has enough assets to cover its liabilities. It can also determine if the company is taking on too much debt or if it is financing its growth sustainably. Equity can also show how much of the company is actually owned by its shareholders, which is a key measure of value for investors because it can indicate the ownership value. Now, let's continue on with the unique components of the balance sheet. At number 1, we have assets. So assets represent everything the company owns or has control of. These can be categorized as current assets and non-current assets. Current assets are the assets that are expected to be converted into cash or used up within a year. Common examples include cash, which is money in the company's bank account, accounts receivable, money that customers owe to the company, inventory, which is products or materials the company holds for sale, and so on and so forth. Non-current assets, however, are the assets that will provide value for more than 1 year. Examples include property, plant, and equipment, which can be abbreviated as PP&E. Physical assets like buildings, machines, or vehicles fall into this category. Intangible assets, such as patents, trademarks, or goodwill, are also non-current assets. And to calculate the total assets, there's actually a formula which is very simple to understand. It's current assets plus non-current assets. Moving on to liabilities. This represents the company's debts or obligations, money it owes to others. Like assets, liabilities are categorized as current liabilities and non-current liabilities. Current liabilities are the debts that the company must settle within a year. Examples include accounts payable, which is the money the company owes to suppliers, short-term loans, which is loans or other obligations due within the next year, accrued expenses, which are the expenses the company has incurred but not yet paid, such as wages and taxes. Non-current liabilities however, are the long-term debts that are due after 1 year. Examples include long-term loans, which are loans or bonds payable over many years, deferred tax liabilities, which are taxes that are owed but deferred to a later period. And the fundamental formula for total liabilities is also very similar to total assets. It's current liabilities plus non-current liabilities. Then we have equity, which represents the amount of money that would be left for shareholders if all assets were sold and all liabilities were paid off. It is also known as shareholders' equity or owner's equity in other balance sheet statements. The main part of equity is knowing the common stock. This represents the amount of shareholders have invested in the company. There's also retained earnings, which are the profits that the company has kept, not paid out as dividends, however, and has reinvested back into the business. There's also additional paid-in capital. This is the excess amount shareholders pay over the nominal value of the stock. All of these things contribute to equity, and equity shows the company's net worth and ownership. For publicly traded companies, it represents the shareholders' stake in the company. Now, the key formula for total equity is common stock plus retained earnings plus additional paid-in capital. All these things make up total equity. Moving on forward, we can see some examples of the balance sheet. This one I had gotten from another very credible source, basicaccountinghelp.com. Obviously, like I said before, you can find your own accounting information regarding balance sheets, cash flow statements, profit and loss accounts on the internet. There's a lot of great examples there. But as you can see, the total assets, which is $776,000, balances out with the total liabilities and owner's equity. This means that this balance sheet has been formulated correctly and that everything is in balance. If for some reason you find a balance sheet that is not in balance, this suggests that the balance sheet has either been created incorrectly, maybe something has been left out, a key component in assets, liabilities might have been left out, or even owner's equity. And so you must make sure that everything balances out. And if it doesn't, that is a very big problem for investors, and it will definitely cause concern in the long-term future of the company. Here's another good example of a balance sheet. Very simple. Also, straight to the point, $472,100 balances out with total assets, total liabilities, and shareholders' equity. And as you can see, this is all of the categories that fall into assets, liabilities, and shareholders' equity. There's also some more components such as treasury stock, which I did not talk about, that also falls under shareholders' equity, but it very much depends on the business itself and how many components it has. Sometimes businesses may also include or decide to not include certain aspects of the balance sheet, but you have to also, there's an ethical consideration to that, because that means that the balance sheet is not being fully represented. And that's an ethical concern for investors as well, because it shows us that the company is manipulating its financial information, which is also a very big red flag, as there are some very prominent historical examples that were able to do that and got caught. Now, let's look at the interpretation and analysis of the balance sheet. First off, we obviously have assets, which I have covered, but I'll cover again and tell you how we can interpret this further. So a higher cash balance, which is part of current assets, can indicate better liquidity, enabling the company to meet short-term obligations or take advantage of new investment opportunities. High accounts receivable can also indicate that the company is selling well, but it's growing faster than revenue. It could signal collection problems. For non-current assets, a high non-current asset may indicate significant investments in property and equipment, suggesting that the company is capital intensive or expanding. Intangible assets like patents or goodwill should be monitored for impairment, as a large portion of intangible assets could indicate acquisition-heavy strategies that may not pay off. Moving on to liabilities. Obviously, high accounts payable may indicate that the company is taking advantage of payment terms of suppliers. However, rising payables could signal cash flow problems if they are not managed by revenue growth. Companies with significant short-term debt need to have sufficient current assets to cover those obligations. A mismatch between current assets and liabilities could indicate liquidity problems. Now, on the non-current liabilities part, there's also some interpretation that we can take from it. A company with significant long-term debt needs to have a strong earnings and cash flow to service the debt over time. High levels of debt relative to assets could increase financial risk. Shareholders' equity, growing retained earnings suggest that the company is profitable and retained profits for future growth. Conversely, negative retained earnings may indicate consistent losses. There's also the issue of common stock and paid-in capital. An increase in these could indicate that the company has issued more shares, diluting ownership for existing shareholders, or raised new capital for growth. Now, we also need to find out the key ratios for the balance sheet, because this will allow us to interpret the financial information even further. So the very most popular, the best ratio that people use is the liquidity ratio. This measures a company's ability to cover its short-term obligations with its short-term assets. And the formula for the current ratio, which is part of the liquidity ratios in general, is current assets divided by current liabilities. Now, what does that mean? Well, when you divide current assets by current liabilities, if the ratio is above 1, this indicates that the company has more current assets than current liabilities, meaning it can meet its short-term obligations. However, a ratio below 1 signals potential liquidity problems. There's also another ratio that we would like to discuss, which is the quick ratio. Now, this is current assets minus inventory divided by current liabilities. This is a stricter measure than the current ratio, excluding inventory from current assets. It shows whether the company can meet its short-term obligations without relying on selling inventory. A ratio below 1 may indicate a company's difficulty in meeting short-term liabilities. Then we have the equity ratio, which is total equity divided by total assets. Equity ratio shows how much of the company's financing comes from shareholders as opposed to debt. A higher equity ratio indicates the company is financing more of its assets with equity rather than debt, signaling financial strength and stability. A lower equity ratio indicates higher reliance on debt, which increases financial risk. There's also retained earnings. This represents the cumulative amount of net income a company has retained after paying dividends over time. Growing retained earnings suggests that the company is reinvesting profits into its operations for future growth. Declining retained earnings, however, might signal that the company is not generating enough profits to reinvest or is returning too much to shareholders via dividends. Now, there's also more general tips we can look at when analyzing balance sheet statements. We can analyze the trends, for example. You can look at how assets, liabilities, and equity are trending over time. Growth in assets relative to liabilities is a good sign, while increasing liabilities without corresponding asset growth could signal financial trouble. You could also compare it to industry peers. Compare the company's financial ratios to its competitors or industry averages to assess its relative financial health. You also need to check for red flags. A consistently low or declining current ratio could indicate liquidity problems. Also, watching for unusually high accounts payable or receivable, which could signal cash flow issues. You could also analyze how the company is financing its growth through debt versus equity. A company with high debt levels might have a higher financial risk, but also a potential for higher returns if managed well. By analyzing these areas of the balance sheet, you could assess the company's financial stability, efficiency, liquidity, and risk level, helping you make informed decisions about its overall health and future potential. With that said, let's move on to our final financial statement, the cash flow statement. The final financial statement that we have to analyze today is the cash flow statement. This is one of the key financial statements that shows how cash moves in and out of the company over a specific period of time. Unlike the income statement, which shows profitability, the cash flow statement focuses solely on cash inflows and outflows. It helps determine a company's ability to generate cash and manage its cash needs. The cash flow statement provides a detailed look at how cash is generated and used during a specific period, usually quarterly or yearly, depending on the company. It highlights the company's ability to operate, pay its debts, invest, and fund its future growth. Unlike other financial statements, like the balance sheet, the cash flow statement only focuses on cash transactions, just as I've said before, not revenue that has been earned but not yet received, or expenses that have been incurred but not yet paid. Now, let's move on to some of the unique components of the cash flow statement. The first one is obviously the cash flow from operating activities. This section shows how much cash is generated or used by the company's core business operations, such as sales of products or services and payments to suppliers or employees. It is often considered the most important section because it reflects whether a company can generate enough cash from its regular business activities to sustain itself. Some key items included in this section are the net income, so that's the starting point, which reflects the profit, adjustments for non-cash items, depreciation, amortization, which are non-cash expenses that are added back, changes in working capital as well, which is the changes in inventory, accounts receivable, or accounts payable. The next one that we need to talk about is cash flows from investing activities. This section shows cash used for investments in the business, such as purchasing long-term assets like property, equipment, or securities. It also includes cash generated from selling these assets. Some key items included in this section are the capital expenditures, which is cash spent on acquiring fixed assets such as machinery or property, and sale of assets, which is the cash received from selling assets or investments. Now you may wonder, why is cash flow from operating activities or cash flow from investing activities so important? Well, the reason why cash flow from operating activities is so important is because cash flow from operations tells us if the company's normal business activities are generating enough cash to cover its costs. A positive number here is a good sign, and it always will be. And if that number is growing as the years go by, that is an even better sign, as it shows us that the operating activities are growing at a sustainable rate. Now, why is the cash flow from investing activities important? Well, that's because this section shows us how much cash is being used for long-term investments. It's normal for companies to have negative cash flow from investing activities if they are growing or expanding. However, large outflows here with no corresponding inflows might suggest financial stress, and that is a big red flag for many investors and other stakeholders alike. Finally, we have the cash flow from financing activities. This section shows how a company finances its operations, such as through debt, which are the loans, or equity, which is stock issuance. Stock issuance is giving the stock because it's issued, as well as how it repays debts or returns money to shareholders in the form of dividends, share buybacks. Now, some key items included in this section are the issuance of debt or equity, cash inflows from borrowing money or issuing new stock, repayments of debts, cash outflows to pay back loans, dividends paid, which is the cash paid out to shareholders. Why is this section important? Why is financing activity so important? Well, it is so important because it shows us how a company is financing its business, whether it's taking on more debt or raising capital through equity. A lot of inflows from financing might mean the company is borrowing too much, while outflows like dividend payments shows that the company is returning value to shareholders. Now, there's common areas of confusion for beginners when it comes to the cash flow statement, one of them being the cash flow versus profit. Beginners might confuse cash flow with profit, and that is nothing to be worried about. Cash flow refers to actual cash coming in and out for the business, while profit is what is left after all revenues and expenses are accounted for, even if the cash hasn't been received yet. There's also the difference between the positive and negative cash flow. Not all negative cash flows are bad, however. For example, negative cash flows from investing activities can be a sign that the company is expanding or investing in a future growth. An example of this can be buying new equipment. Operating, investing, and financing. Now, these are the three different areas of the cash flow statement, and we need to analyze their differences in order to make sure that we know what part is responsible for the cash flow statement. Now, understanding the difference between operating activities, which is the day-to-day of the business, investing activities, which is the buying and selling of assets, and the financing activities, which is the debt and equity, can be quite confusing. Each section has a distinct role in showing where cash is coming in from and going to. The ways to interpret the cash flow statement is very easy. Once beginners understand the basic structure of the cash flow statement, they can start interpreting it to gain insights into a company's financial health. And that is the difference between the operating, investing, and financing activities. But here are some key ways to interpret these activities in more detail. But before that, let me show you some examples of cash flow statements. So this is another one that I got from sleek.com. As I said before, you can check these websites out for yourself. You can find more cash flow statement informations in websites in general. Some of them are obviously much more detailed than the ones that I'm showing here, but generally speaking, this is how a cash flow statement would look like. So you obviously have the operating activities, you've got the investing activities and the financing activities. You also have net cash flows and cash balances. And as you can see here, there's the depreciation, there's the accounts receivable, accounts payable, there's the proceeds from sale of fixed assets, proceeds from long-term loans. All of this information is very important. And I must mention that when you see the number on the right-hand side being covered in brackets, that means it's an outgoing. It's basically taking it away. So you're subtracting that number from the overall total. And here's another example here from Investopedia as well. They have it labeled in blue, the expenses with the blue brackets. And as you can see here, they have a pretty good cash flow as they have 1,522,000, pretty good. And now it's time to go into the interpretation and analysis of the cash flow statement. So, analyzing the operating cash flow activities is very important. Let's see how that is operated in more detail. Operating cash flow shows whether a company's core business is generating enough cash to maintain itself. Positive operating cash flow means the company can cover its operating expenses. If operating cash flow is negative, it may indicate that the company is struggling to generate cash from its main operations. What do we have to look for? Well, positive operating cash flow is the first thing, because it indicates a healthy business that's generating enough cash to cover expenses. However, we do not want to look out for the negative operating cash flow, as this can be a warning sign that the company may not be generating enough cash to sustain its operations. Obviously, we also need to assess the cash flow from investing. The cash flow from investing activities shows us how much a company is investing into its future growth. If the company is making large investments, such as purchasing property or equipment, it might have a negative cash flow in this section, but that can be a positive sign if it leads to growth in the long-term future. This is why it's so critical to be patient when looking at the financial statements of your company, because it might completely change and turn on its head after a couple years go by when the investments are starting to pay off. What do we have to look out for when we look at cash flow from investing? Well, negative cash flow from investing is very important because this is usually a good sign if it's due to the company investing in long-term growth, such as buying new equipment. Positive cash flow for investing may indicate that the company is selling assets, which could either be good or bad depending on the reason for the sale. We also need to examine the financing cash flow. Financing cash flow reveals how a company is raising and spending money. This includes taking out loans, issuing stock, or repaying debt. If a company is borrowing a lot of money, it could be a sign of financial strain. If it is paying out dividends or buying back shares, it's returning value to shareholders. What do we have to look out for here? Well, positive financing cash flow may indicate that the company is raising capital through debt or equity, which could signal expansion or financial distress if it's over-relying on debt. Negative financing cash flow often refers to that the company is repaying debt or distributing dividends, which can be a positive sign of financial strength. Now, let's move into the free cash flow section, which is part 4. Free cash flow is an important metric for understanding how much cash a company has left after paying for its operating expenses and capital expenditures. It shows how much cash the company has to pay down debt, pay dividends, or invest in growth. Now, free cash flow is a formula, which means free cash flow is equal to operating cash flow minus capital expenditures. If a company has a strong free cash flow, it means that it can fund its growth without needing to borrow money or raise more equity, which is a very good sign for investors and stakeholders alike. High free cash flow is also a positive sign that the company has cash left after covering its necessary expenses and investments. However, lower negative free cash flow could indicate that the company is struggling to generate cash after its operations and investments. So, to sum this all up, we have the operating activities, which shows if the core business is generating cash. Positive operating cash flow means the company can sustain itself. We have the investing activities, which reflect how much the company is investing in its future. Negative cash flow here can be a good sign of growth as well, as we've mentioned previously. Financing activities shows how much the company raises capital and repays debt. Look for trends in borrowing or paying back. By interpreting these sections together, beginners can get a holistic view of the company's cash situation, whether it's making enough money from its operations, how much it's investing in its growth, and whether it's borrowing or paying back money effectively. And also you have the cash flow per share, which is another detailed part, but that I don't want to discuss it in this section because it is extremely advanced. And I do believe that if you are very interested and inclined to learning more about this information, there's a lot of good sources such as investopedia.com, which will allow you to gain more information and go further into analyzing what financial statements truly are. Now, here's all the lists of methods for analyzing financial statements. There are some that we have covered. There are some that you can guys cover in the future as well. But generally speaking, this is how you can break them down statement by statement. Looking at all of these metrics is very important and obviously will give you a better insight into how a business is doing on a year-to-year basis. Now, some practical tips for financial statements. You always need to look at the trends over time, not just single year data. The world is constantly changing, and we saw that with the COVID-19 pandemic. A lot of investors were shocked after their investments had actually underperformed during that period because so many businesses were shutting down and it was very difficult for many of them to operate. A lot of them had to signify job losses, job cuts, and that obviously had decreased their productivity overall, but they were doing it to save their business. But in the end, most of these businesses, which were small to medium size, had actually closed down because of the pandemic. So these types of restrictions and unpredictable events can always happen. And some people who have kept their investments, even after COVID-19 pandemic, may start to be able to gain back those benefits after their businesses have been reinvested into and have survived the pandemic and are starting to operate as they used to back in the normal days. You also want to compare the industry averages for benchmarking. This is very important because sometimes if you can analyze and see that your business that you've been investing in is not maintaining or at least performing to the benchmark of all the other industry averages, then it might be a sign to switch to a different business or look for alternative investing options. You also want to watch out for accounting adjustments that may distort real performance. Some businesses may have the evil intention of manipulating their financial statements so that investors invest into them, when in reality, it is actually disproportionately incorrect and it might be a completely different financial statement altogether. So looking at all of these measures should give you a better idea of what to do when analyzing financial statements. That is it. That is the end of the video. Thank you very much and goodbye.